Earlier this July, a headline set off shockwaves in a very small corner of Indian markets.
One of the biggest crackdowns on a foreign player,
Jane Street.
Market regulator SEBI.
Last week it made a rare move. It banned one of Wall Street's biggest trading firms, Jane Street.
A US-based quant trading firm, Jane Street, was accused of manipulating the Bank Nifty index.
So it has banned the company and slapped a fine of about $570 million.
It may actually be the biggest fine if it materializes ever.
For most people, it was just another market story. But for derivatives traders in India, it felt like a rude shock. And a reminder that somewhere behind the regular trading apps, there are players operating at a completely different speed and scale, and maybe impacting the trades taken by retail traders. Now, Jane Street has denied the allegations though. It regained access to the Indian markets after depositing the penalty amount and has also filed an appeal with the Securities Appellate Tribunal (SAT) in September, seeking additional data and documents. But this episode is not about who's right or wrong or Jane Street specifically. This episode is about firms like Jane Street and a handful of others who operate in the world of high-frequency trading, HFT firms as they're called. Firms that fire millions of buy and sell orders in seconds, capturing tiny profits from the order book and adding it up over thousands of trades. They co-locate next to the exchange servers live in microseconds and make their money in the gaps most of us never ever see on the screen. Who are these firms and what exactly do they do? And what does their presence mean for everyone else, from intraday traders to long-term investors? I'm your host Sandeep Rao, and in this episode we are going deeper into the world of high-frequency trading, who these firms are, how they really make money, and how their strategies shape the market that all of us trade in. With that, let's get started. Like I always do, let's start with the origin story. Where did HFT, high-frequency trading, actually come from? To answer that, we have to start with a really bad day on the Wall Street. The day was October 19th, 1987, now known as Black Monday. The Dow Jones fell about 23% in a single day. Prices were collapsing so fast that the human market makers on the floor just stopped picking up their calls. If you were a regular investor trying to get out, you were basically stuck watching your portfolio melt while nobody answered your call. If you ask me what caused that crash, there's no one singular reason. It was an ugly combination of overvalued markets, nervous sentiment, and computer-driven selling all kicked in together, turning a normal correction into a full-blown cascade. In the aftermath, regulators and exchanges realized something. Relying on humans to manually answer phones and trade, especially during a panic, was structurally a bad idea. So Nasdaq tweaked an existing system called Small Order Execution System, SOES. They made it mandatory for market makers to instantly execute small electronic orders, typically 1,000 shares or less. Retail-sized orders got automatic priority execution, and the big institutional blocks would have to wait for their turn. This is when a tiny group of very sharp traders saw an opportunity. If small electronic orders get priority and instant fills, then whoever can react fastest to the changing quotes can hit those prices before everyone else. These traders started zipping in and out of stocks all day using the SOES system, scalping tiny profits over and over again all through the day. They became known as the SOES bandits. And they are basically the grandparents of modern day HFT. Speed, tiny edge, repeated thousands of times, but all done manually. One of the most famous bandits was Harvey Hodkin, who ran a firm called Alltech. He started teaching this style of trading, opening rooms full of screens where people did nothing but hammer trades all day on SOES. Around the same time, another interesting story was unfolding. Gerald Putnam, who ran a small brokerage firm called Terra Nova, also opened SOES trading rooms around the US. To save money on expensive Nasdaq terminals, he routed all those branch orders over the internet into a central hub in Chicago. That setup gave him an idea. If I'm already routing and netting all these orders centrally, why can't I just match some of them internally with a computer? That was in a way the first ECN, an electronic communication network, where a matching engine pairs buyers and sellers automatically. While all this was happening, there was another firm called Datex Securities in New York where two young techies, Jeff Citron and Josh Levine were pushing this innovation even further. They built a trading system called Watcher that supercharged the SOES trading. It let day traders fire orders at insane speed compared to everyone else. As their flow grew, they realized they could often match trades against each other electronically, and out of that came the Island, one of the earliest and the fastest ECNs on Wall Street. Island became known for its blazing fast machine engine. It started quietly eating into Nasdaq's business because traders loved how quickly and cleanly it executed orders. Gerald Putnam saw this and took the ECN idea and went one step further. He launched the Archipelago, another ECN, and wired it not just to match trades internally, but also intelligently route orders out to other exchange venues if there was no internal match. That was the birth of Smart Order Router, a piece of software that looks across multiple markets or exchanges in real time and decides where to send your order for the best execution. So now you have SOES bandits making money with speed, ECNs like Island and Archipelago matching orders electronically, and smart order routers stitching together multiple markets and exchanges. In the late 90s and early 2000s, a couple of things poured rocket fuel into the setup. First, new rules forced exchanges to display ECN codes right next to the traditional market makers. Now suddenly, these electronic venues became first-class citizens. Second, decimalization in 2000 shrank tick sizes to 1 cent. Spreads got tighter, traditional market making became less profitable for humans. And suddenly it made a lot more sense to let ultra-fast computers fight over those tiny, fractional edges instead. By the mid-2000s, the big exchanges basically conceded that the future was electronic. Nasdaq bought the technology behind Island, the NYSE bought Archipelago, and those matching engines became the core of what these exchanges run on today. Alongside them grew a new class of firms whose whole business model was see the market a little faster, react a little faster, and capture a tiny bit of edge 1,000 times a day. Those were the high-frequency trading firms, Tower and Getco being the early ones. India's HFT story begins a bit later. SEBI opened the door to algorithmic trading around 2008. NSE rolled out co-location around 2010, letting firms park their servers next to the exchange's machines. From there, the same pattern plays out. More automation, more ECN-style matching, more emphasis on latency and order flow intelligence, and a gradual rise of HFT-style strategies in our own markets. So HFTs started with a market crash in the US that broke the old manual system, then a small group of traders using SOES a bit more cleverly than everyone else, then ECNs like Island and Archipelago wiring those trades into ultra-fast matching engines, and then finally an arms race of speed, smart routing, and automation. That's the origin of the high-frequency trading, from SOES bandits on clunky terminals to co-located servers fighting over microseconds. But what exactly is high-frequency trading? Well, there are two ways to look at it. There's the generic conceptual definition and there's the regulatory definition. Let me walk you through both. First, conceptually, high-frequency trading is just algorithmic trading done at extreme speed and scale. There is a code that reads the market data in real time, makes decisions in microseconds or milliseconds, and sends loads of orders and cancellations throughout the day. The edges are tiny, maybe a few paise a tick or a fraction of a tick, but the game is to do this thousands or millions of times. HFT firms invest heavily in speed, co-location next to the exchange, super optimized code, fast networks, sometimes even specialized hardware. Their business model depends on being faster than others by tiny but consistent margins. Now, the regulatory view. In India, SEBI treats HFT as a latency-sensitive, high-intensity subset of algorithmic trading, the kind that runs through DMA and co-location, fires a large number of orders per second, and shows very high order-to-trade ratios. It sits inside the broader algo trading bucket but behaves differently enough that SEBI can place extra controls around it. That's why SEBI keeps an eye on both speed and order intensity. It allows exchanges to cap orders per second, OPS, for algos, for example around 100 to 120 orders per second in some segments, and it actively monitors order-to-trade ratios or OTRs. Now you may ask what OTR is. Order to trade ratio or OTR is simply the ratio of how many orders you send to the exchange versus how many of those orders actually turn into trades. In formula form, it's OTR is equal to number of orders sent divided by the number of trades executed. For example, in one day you send 20,000 orders and only 200 of them get filled, then your OTR is 20,000 divided by 200 is equal to 100. So OPS and OTR are the two factors that SEBI monitors, and this is how HFTs are defined by the regulator. So far, we've understood how HFTs started and what actually defines them. The next obvious question is, what do these firms actually trade? And how is that changing in India right now? At a high level, most HFT desks in India and globally run some mix of market making, different kinds of arbitrage, and very short-term order book driven strategies. The common thread is always the same. They are not trying to predict the next trend, they are trying to capture tiny, repeatable edges over and over again with very short holding periods. A big chunk of HFT activity in India is classic market making, that is being the plumbing of the market while providing liquidity. These firms continuously post both buy and sell quotes on instruments like index futures, stock futures, options, and sometimes even in less liquid names. The goal is to buy a bit cheaper and sell a bit higher, keep positions small and turn inventory very quickly. They earn the bid-ask spread and small pricing edges but do it thousands of times a day. Global players like Citadel and Indian shops like AlphaGrep or Graviton all have some flavor of this, a core of market making. Then there's something called statistical arbitrage or arbitrage, which focuses on price relationships rather than single instrument prices. In cash futures arb, traders watch the gap between the stock or index and its future price. If the future is too overpriced or too discounted versus the spot plus carry, the algo buys one leg and sells another, waiting for them to converge. In statistical arbitrage, models track how related instruments normally move together: a stock versus a sector, an index versus an ETF, different expiries, options versus futures, even cross-asset spreads, and step in when those relationships drift slightly out of line. The idea is to buy the discounted side and sell the overpriced side. Some of these models can be extremely complex, with hundreds or even thousands of variables driving decisions. On top of that, you have cross-venue arb, that is, cross-exchanges. In India, we have NSE and BSE where the same product trades on multiple venues. If one exchange updates a price a few microseconds earlier than another, a fast HFT can hit the stale quote on the slower exchange and lock in any tiny low-risk edge. Another bucket is order book and microstructure strategies, which live deep inside the order matching engine. These strategies look at where an order sits in the order book queue. Are you first in the line, at the best price, or fifth? The algos continuously place, move and cancel orders to stay near the front, and they watch the pattern of incoming orders to infer when a big player might be about to trade. Holding times here are extremely short, milliseconds to seconds. Now this isn't about I am bullish on Bank Nifty for the next 1 hour kind of a thing. It's about I want to be the first in line for the next few ticks, and I'll adjust as the order flow changes. Options are another area HFTs love, especially in India. For years, a huge chunk of high-frequency activity has been in index options. Weekly expiries and expiry day trades, effectively our desi version of zero-DT options. Options are attractive to HFTs because they move fast, spreads are tight but active, and you can hedge risk dynamically with futures or cash. HFT desks run options market making strategies, quoting calls and puts across multiple strikes and expiries. They also run strategies like volatility arbitrage, trading mispriced and implied vol, and complex hedging engines that continuously rebalance risk in small, rapid adjustments rather than taking big directional bets. A lot of the Thursday madness in the Indian markets over the last few years has been driven by these expiry day microsecond option strategies. Not everything inside a quant or HFT firm is ultra low latency. There's also a large and growing bucket of systematic intraday or mid-frequency strategies. These trade on 1 minute, 5 minute or even longer time frames, are usually fully systematic and data-driven, but are less obsessed with shaving off every microsecond. Many small players in India live in this mid-frequency space. They still run systematic models, often on index futures or baskets of stocks, but without the heavy hardware or network spend that true high frequency requires. Interestingly, what's changing now is the mix. After SEBI's crackdown on India's once frenzied weekly index options market, exposure caps, restrictions on expiries, real-time surveillance, and a sharp drop in index options turnover have all put pressure on the old pure expiry day microsecond option churn model. The investigation into Jane Street and the broader tightening around derivatives have pushed India's HFTs to relook at their businesses. Firms like AlphaGrep, Graviton, QuadEye, and iRage are still running ultra-low latency systems, but they are also building slower and more data-driven strategies that think in minutes to hours instead of microseconds. They are leaning more into cash equities, longer-dated index derivatives, stock derivatives, commodities, and cross-asset trades, and they are expanding to markets like the US, Japan, Brazil, Southeast Asia, Singapore, and Europe as a hedge against tighter rules and shrinking margins at home. Along with diversifying across different geographies, many HFTs are also exploring the crypto markets. Inside many of these firms, now you effectively have two worlds. One side still focused on pure HFT co-located ultra-low frequency Q position games, and another side focused on mid-frequency and quant asset management style strategies powered by machine learning and richer datasets. If you zoom out, the story is that HFT in India is evolving from a narrow focus on speed and expiry day leverage in weekly options to a broader multi-asset, multi-horizon quant ecosystem. The DNA is still the same: systematic, heavily engineered, cost-obsessed, but built around small, repeatable edges. But those edges increasingly live across market making, arbitrage, options, cash equities, commodities, and global markets, spread across both high-frequency and mid-frequency styles, rather than just 0DT Bank Nifty at microsecond speeds. Now let's move further. Now that we have a sense of what strategies HFTs trade, the next question is, who are these firms? How much money do they make, and what is this business really like from the inside? In India, the HFT world is dominated by proprietary trading firms, outfits that trade their own capital and have their own broking license, plus a few broker prop desks and subsidiaries of big global players. On the homegrown side, firms like Graviton, QuadEye, AlphaGrep, iRage, ST Advisors, Daulat Group, NK Securities, and a handful of others form the core of the ecosystem. Alongside them, you have global firms. Firms like Tower Research Capital, Jump Trading, Hudson River Trading, Citadel Securities, Jane Street, and others. They have Indian entities or FPIs that plug into the NSE and BSE using the same co-location and low latency infra as local players. Among these, Tower was one of the earliest international HFTs in India. And then there's another layer: global quant asset managers and hedge funds, names like World Quant, Millennium, and others, who may not be doing pure microsecond HFT here, but run medium-term stat arb and quantitative strategies into India from offshore structures. Structurally, almost all these have a broker membership at the exchange. The broking license offers two buckets: client accounts and a proprietary or prop account. The big HFT shops mostly use the prop account, trading their own capital, and that's partly for control and partly for saving costs like stamp duty, etc. They take exchange connectivity through co-location, literally renting physical space and rack units in the exchange's data center, and then cram those racks with custom-tuned servers, network cards, and software optimized to shave off those microseconds. So the next question is, how much money do these firms actually make? Let's start with Graviton. Based in Gurgaon and founded in 2014 by IIT Delhi alumni, is often cited as the current top dog. Money Control reports that in financial year 23, it did a whopping 3,525 crores in revenue and around 605 crores in net profit, purely from quant and algorithmic trading. AlphaGrep, another Mumbai-based quant firm, saw its net profit explode to roughly 207 crores in financial year 22, up from under 3 crores just a few years earlier, as revenues climbed close to 800 crores. Daulat is one of the few listed names where you can actually see HFT-style profits show up in public filings. NK Securities, iRage and ST sit in the same cluster of highly specialized, mostly quiet and very profitable quant shops. Jump's India arm has scaled fast, and recent regulatory data suggests revenue of well over 2,500 crores for financial year 24. Citadel Securities has been building out of Mumbai as a global market maker, and Jane Street, before SEBI's interim order, is estimated to have earned billions of dollars from Indian options over just a couple of years, with SEBI alleging roughly 567 million or around 4,800 crores in unlawful gains now logged in an escrow account. Graviton's revenue, Jane Street's Indian options hall, Tower's long-running volumes all point to a business where a handful of firms collectively turn over tens of thousands of crores and pull out serious profits if they get the tech and the risk right. But at the same time, margins have been crushed over the last decade. People inside the business will tell you where you might have earned, say, 1 paise on every 100 rupees of turnover in 2010, you're probably closer to a third of that, something like a 0.3 paise, because spreads are tighter, competition is fierce, and transaction costs plus stamp duty eat a big chunk of your edge. The game is no longer about fat spreads. It's about huge scale and relentless cost optimization. The risk side of it is real too. This is a world where a bad deployment or a broken risk check can burn crores in seconds. Think of Knight Capital in the US, which famously lost hundreds of millions of dollars in under an hour due to a software glitch. Engineering in HFTs isn't just good infra, it's more about survival. Therefore, a lot of salary pool goes into systems, network and hardware engineers who can keep latency low, clocks in sync and kill switches working. You'll often hear numbers like upwards of 1 crore per annum salaries for engineering roles and far more for top traders and partners, plus big deferred bonus pools. And as I said earlier, because margins are thinner, regulation is getting tighter, these firms have now become more globally focused. Indian HFTs and quant shops now routinely run strategies across 30 plus exchanges worldwide. US equities and commodities, Brazilian futures, European and Japanese markets, even crypto. India remains attractive because of its massive derivatives volume, but firms hedge their business risk by also making money across other geographies. While some markets like China are seen as painful on the regulatory and operational side, others like US futures or certain crypto venues are seen as more lucrative for the same tech stack. The overall picture is this. India's HFT landscape is a tight group of specialized prop firms plus a handful of global giants and bank desks, all fighting in a brutally competitive, low-margin, high-fixed-cost business. When it works, the numbers can look absurd, thousands of crores in revenue and hundreds of crores in profit. When it doesn't, a single bug, a single rule change from the regulator, or a sudden shift in the market structure can wipe out an entire line of strategy overnight. It's less like a gentle asset management business and more like running a high-tech, high-stakes trading factory. Huge fixed costs, razor-thin unit margins, constant pressure to innovate, and a global race to find the next micro-edge before someone else does. The question that often gets asked is, are HFTs good or bad for India? The honest answer is they are a net positive in function, but sadly they are portrayed as villains. On the plus side, HFTs make our markets deeper and tighter. They narrow bid-ask spreads, keep quotes available almost all the time, and absorb a lot of short-term noise. Now, if you abruptly shed them off tomorrow, volumes would drop, spreads would widen, fills would get worse, and the markets would feel slower and boring for everyone from intraday traders to large institutions. Also, most serious HFT shops don't actually want to move prices. Their ideal world is lots of small, uninformed flow where they can trade in size without leaving footprints, capturing tiny, low-risk edges over and over again. So in totality, HFTs are critical market infrastructure run by profit-seeking firms. And the real question for the ecosystem is whether regulation can keep benefits of liquidity and tight pricing while curtailing the tail risks and bad behavior. Now, am I asking for too much from both the regulator and the HFT firms? I don't know, but I think it's possible for both to work in a way that benefits the overall ecosystem. So that brings us to the end of this deep dive on HFTs in India. I hope you found this episode valuable. Do share your questions, thoughts, and feedback in the comments. I'll do my best to respond. Thank you for watching and see you in the next one.